Hi everyone, welcome back to Berry's podcast. So before we begin this video, there are a few questions which was asked regarding the Tata Motors demerger. So we'll discuss that and we'll go into this video. So firstly, what will happen to the Tata Motors DVR share regarding the Tata Motors demerger?
Okay. The DVR conversion to Tata Motors shares will first happen. After that happens only, the demerger happens.
Okay.
So there will now be Tata DVR shares at the time of demerger. So they already spoke about the DVR. They've got approval from investors. They got approval from board. They've got approval from everybody. So that will happen first. After that happens, then the demerger will happen. So there's no question of any DVR shares being there.
And the next question is, a person has asked regarding the dividend payment within the companies. We as a shareholder get dividends. So the parent company will give the dividend amount to the subsidiary company. So how does the taxation work in that?
When the subsidiary company gives the parent company dividends, of course it's taxed. Those tax laws are different because that's within companies. And companies have a lot of leeway of claiming all kinds of things. It's like a consultant. You can claim all kinds of things and government will allow those. It's allowed legally, which is not there allowed for salaried people. That too, if you stick to the new regime and tax, you really cannot make any deductions. But it's very different between companies and that is very complicated. And it is of no real value for an investor to dive into that in great detail, especially when you're a small investor like us, trying to buy small amounts over a long term. Once you become like Warren Buffett, you got crores, and then you're decide to buy I want to buy 15% stake in this company. Then all this kind of analysis is useful for you because you're going to be footing a bill of 1,000 crores. Correct? Then you want to analyze all that. At this level, don't worry about it too much.
And going to this video, I've read the financial statement of L&T and ITC. In that, I read the cash flow statement in particular. So there is a general thing that the FMCG companies will have quick cash flow and the infrastructure companies like L&T will have slow cash flow. So how does it reflect in the overall performance of the company?
What is the purpose of a cash flow statement?
It says the ways in which the company is getting the money.
It tracks cash movement. It is similar to your savings account.
Okay.
If you open your savings account, right, you'll immediately know where money is coming from, where all your money is going.
Yeah.
For a company, savings account is cash flow. And cash flow is time period. Meaning you put a time period in.
1 year, quarter.
1 year or 1 quarter. So it's limited to a time range.
Okay.
Like how you look at a bank statement. You say 1 month statement, give me your 6 month statement. So you're looking at that track for that amount of time. Right? And the accounting which is used for that is not accrual accounting, it's known as cash accounting. The methodology which they use. It has a start date, it has an end date, right? And it begins with the net income from the income statement. If you pull out the income statement, there will be something known as net income. That's where the cash flow starts from. So in that you have 3 main subcategories inside your cash flow statement. Right? First is operating activities. Operating activities are non-cash charges is the first thing. Then you have changes in working capital, right? Plus non-cash charges is added to the net income. Then you will have non-cash charges are things like depreciation, amortization, stock-based compensation. Those things that would be added into net income. Then what gets plus or minus changes in working capital could be receivables and payables and inventory.
Okay.
That can add or minus depending on what it is. So that gives you the total cash generated from operations. Then what do? You come to the next one, which is known as investing activities. Under investing activities in the cash flow, you'll have something known as capital expenditures, acquisitions, and sales of investments.
Okay.
Once those minuses and plus happens, you'll get the net cash from investing activities. So capital expenditure could be cash spent on building equipment for your factory. Cash paid could be to acquire another business. If you're going to buy your competitor out, those acquisitions will come into this. These are all subtracted from operating cash flow. Then what is added into it is cash proceeds from asset sales. Let's say you sold off some machines. You sold off a factory or sold off a subsidiary. That cash will come into this. After that is done, you'll get to the net cash from investing activities. Then comes the last bit, which is the financing activities, where you're either repaying debt or you're taking borrowings. So that gets added or subtracted. Then you issue or repurchase stock. The company buys back stock or is issuing fresh stock. That gets added and minused. Then dividend payout. paying the investors the dividend. That gets subtracted from this, right? After that, you'll have the net cash from financing activities. So you have net income, you remove the operating cash flow. From there, you do the acquisitions and everything. You get into net cash flow. Then from investing activities, that is, then you get into net cash from financing activities. So this finally will give you the cash flow statement. What is this difference between construction company and FMGC company? Construction company, by nature itself, the business itself is slow. Right? What do they do?
On a period basis.
Correct. And the period building takes long time to build. Infrastructures take long time to build. So the cash movement in this is very different compared to an FMGC company where things are manufactured, sold.
It happens quickly.
Correct. And the volumes are different. So that's why ITCs will have a different cash flow statement compared to an L&T construction. But both, one, it tells you as much as an investor, what you get to know is where is how the company's money coming from, where all the company is making money from, and what all the company is spending money on. All that information is there in the cash flow. So you can study that and you can understand that. But there are three main things you should remember. One is income statement. Income statement is your company's budget.
Okay.
Right? It's like your monthly budget, what you decide to do every month, right? Second is balance sheet. You should know about balance sheets and how to read balance sheets. That is a snapshot. That's like your blood report, right? It's like your net worth. If you want to compare it financially, it's like your net worth. What is your net worth? You'll take my bank account money, my investment money, my property, my jewelry. You'll add it all together and say, this is my net income. That is what? Net worth. Same thing is what balance sheet does. And cash flow is how money moves. It is a savings account. Take the checking account to see how money is moving in. These are the three statements which are the pillars.
Okay.
And you should understand all three statements. Once you understand all three statements, then it becomes very easy for you to analyze any company. Anand knows these three statements, these three pillars he knows very well. Because he started reading this at the age of 9, 10. Okay. My grandfather was a chartered accountant. So at that time he's been looking at this. So once you understand how money moves through all this and how money is read in all this, then like a blood report, we get a hemoglobin count, we do not know anything. We look at the guide next to it, it'll say reference, how much it should be. If it's not
the
that
standard value.
It'll say over there, immediately if it's not that, something is wrong. We should go see a doctor. The doctor will look at it and say, nothing to worry about, man, don't worry about it. These variations will be there.
Okay.
Sometimes the lab itself would have done some mistake. So they'll say, don't worry about it, go redo the test. So same way, unless you become an expert like a doctor and you're able to look at a balance sheet and evaluate it and understand how it is. You look at anything and you do not know if you should be scared or nervous or what. Everything looks very scary because you're putting your hard-earned money into it. So my advice is learn all three. Learn income statement, learn balance sheet and learn cash flow.
Okay.
How all three work, why all three are important and how it's interconnected. If you learn this, then you become an expert.
So when looking at the cash flow statement, under the profit before tax, it is mentioned as adjustments and few things are added in that and the tax is reduced. So what are adjustments which the company will do?
These are all allowed legally. These are all accounting terms. Government allows you to take certain discounts, right? If you are paying loan, like how in personal income tax, if you have home loan,
insurance
you can, insurance, you can tell government I have all this and you reduce your tax liabilities. Okay. Same way, companies also have certain categories which they can claim on their income before they pay tax. So that's all it is. They're claiming these categories which is allowed legally. So it reduces their overall tax.
One more thing, there is a term called depreciation, amortization and impairment loss. It is mentioned in the cash
impairment loss we spoke about recently. I think it was in Tata Motors, where the JLR loss, that impairment loss, they brought it into their books in Tata Motors. The loss they had in England, they brought it into...
Profit before tax was...
Correct. So it immediately became negative. Everyone like, oh, they're making loss. Something negative, something is bad happened. Nothing bad. They just took an impairment loss. They told the government of India, we can't pay tax for you because we had such a huge loss over there. Okay, explain. A lot of business companies create movies. Why do you see everybody making movies? Reliance, everybody making movies. Because if a movie goes kaput, they can claim they spent 100 crores, 1,000 crores in the movie and made no returns. It's a loss.
Okay.
And they write off losses into that movie. So same way, Tata Motors, JLR had some losses which they brought, that's impairment. Next is depreciation. Depreciation is an accountant term. What's allowed is something when it depreciates, means losing value. So when you buy your phone, you bought when first day you bought it, before you buy it, it's worth 1,000 rupees. The minute you buy it, it's only worth 900 rupees. Not even open the box. You've just bought the phone, paid money, and you take the box in your hand. immediately it's become 900 rupees.
Okay.
If you want to return it, the shop will say, I'll give you only 900. So that slows depreciation. So longer you have a product, more and more it depreciates, so you can keep minusing it.
So the assets of the companies like machinery will decrease in the value.
Correct. Then after it becomes zero, when you sell it, right, it's actually you're selling it for pure profit. That's why you'll see companies where a table has been there for 5 years, 6 years. Then they'll say it's completely written off. They'll want to buy a new table so they can start cutting again in tax. So that old table, they'll say you take it for 1,000 rupees. You'll be like, man, looks new. This table looks, everything looks fine. Why are you giving? Because this table's been written off. They just want to get rid of it. Yeah, they are more keen on buying the next table because that's how companies work. So this is depreciation. Amortization is what?
I read the definition. It says that the asset will depreciate in value, and by time they calculate that by 1 year it should depreciate only this much, and if it depreciate more, they'll write it as amortization.
Correct. It's depreciating faster than the rate of depreciation which has been assigned. Then it becomes amortized. So the amortization, depreciation, and impairment are all accounting terms. As an investor, diving deep into that doesn't give you anything. Other than the fact, let's say you suddenly see Tata Motors suddenly saying they don't have to pay tax, they made a loss of 800 crores. Then you can look into it to see why, right? To understand why. But this is very useful only if you're analyzing small cap companies, which let's say worth 100 crores, and you take its balance sheet. There you should look at this. In a company like ITC, L&T, Tata, you looking at this is of no use. It's like you go into Nilgiris, whatever price he says, you will buy. You can't haggle with a guy in Nilgiris and saying, I will not pay 30 rupees for this coconut, I'll only pay 25 rupees. He'll say, sir, please leave.
But in a roadside shop, we can.
Roadside will be arguing. He'll say, she'll shake and say, doesn't look right, looks very old, and this and that. You'll argue with him, though you should not do with a poor man. But that's how human nature is. So, same is true as an investor. So, the reason why you'd have to pour this kind of attention into a small cap company, if you have bought one balance sheet, whenever you do bring, we will see, you will be able to see it. And then you should be wondering, the company is so small. Why is he depreciating so much? What are the equipment in his factory? What is he making? He's only got one factory. He's got some 5 crores worth of machine in it. But he's claiming so much depreciation. Why? Because these are different routes. Owners can use to take money out of the company and line their own pockets. You understand? It's all allowed legally. But if you see the guy is busy lining his pocket and buying one car for his brother, buying a car for his mother, buying one jet plane for his son to go to college, then you have a problem. Then you have to say, boss, wait. It's your choice. You want to claim depreciation buying jet and everything, but I don't think your company can afford it and I don't want to be investing in it. So there, it's very useful. But in a company like Ratan Tata's Tata Motor or L&T, what do you want to sit and understand this? This is why I say, don't bring L&T, don't bring Tata Motors. But you keep bringing you one day, hopefully.
Yes, sir. So I hope that this video was informative and you had some knowledge about the cash flow statement. And if you found this useful, please share it with your friends whom you think it will be helpful for them, so that they can understand the cash flow statement. And please subscribe to this channel for more kind of videos. See you in another episode with an interesting topic. Thanks for watching the video.
Thank you.